Good morning, everyone. It's 10 o'clock. We'll go ahead and call the meeting to order. First item of business is item number 2, to approve the minutes of the meeting of August 13th, 2015.
Second.
Got a motion and a second. All in favor? Aye. Ayes have it. Item number 3 is to receive the report of judgments for the month of July. Have motion and a second. All in favor? Aye. Ayes have it. Item number 4 is to ratify approvals. We'll take all the items at once.
Second.
Have motion and a second. All in favor? Aye. Aye. Ayes have it. Item 5 is to approve the claims docket. We have motion and a second. All in favor?
Aye.
Ayes have it. Item number 6 is to approve the following applications for service retirement, and we have 7. A motion and a second. All in favor? Aye. Ayes have it. Item number 7 is to receive the report of death, authorize the secretary to make necessary changes to conform on the following. We have 1 case. Motion is second. All in favor? Aye. Ayes have it. Item number 8 is ratify approval of the following to terminate vested rights and receive a lump sum payment of their employee contribution account. We have 1 item.
Got it.
Motion is second. All in favor? Aye. The ayes have it.
Mr. Chair, I have one question related to that item.
Yes, ma'am.
Does that include the interest accrued up to date with disbursement?
Yes, this is their employee contribution account, which includes both their contributions and the interest.
Okay. Okay, item number 9 is the investment consultant report. Jason?
Good morning.
Good morning.
We have a little bit more detailed ASAP for you. Thought it would be helpful to have some capital markets update through August concerning the events that have occurred. Really, we've had a coalescing of a number of negative events that have severely impacted equity markets over the last 2 months since the end of the quarter. Certainly, slowing growth in China has been a major factor, coupled with the concerns now about what does the Fed do, because coming into the end of June and for most of this year, the expectations were that the Fed would raise rates sometime this year. So markets really concerned about the Fed raising rates in September or even December based on what we've seen. That said, you know, the Fed governors aren't all there to make sure we prop up the markets. Their focus is on inflation and employment. Although with next year being an election year, we'll see what happens. All that said, this has been a fairly healthy correction. If we think about where we've been, the last 5 years, U.S. equity markets are up 15% a year. We know that's well above historical average returns. So things have backed down a bit. Your portfolio, you have a lot of protection in it. The equity components have held up fairly well on a relative basis. When we look at some of the things that we've done in your portfolio on the fixed income side have primarily been to mitigate against rising U.S. rates and to diversify and have a little bit more opportunistic exposure within fixed income globally, thinking about the intermediate to longer term where rates will go. In the short term, that's been somewhat of a double whammy on the portfolio because you have a little bit more credit, you have more exposure to non-dollar emerging market bonds that relative to U.S. investment grade bonds and primarily U.S. Treasuries, that's been a negative. The degree of that has been fairly minor, but I need to point that out that we're seeing that in the portfolio. So just if you look on page 1, it's the 3rd page, but the slide number is 1. This is broad markets. Year to date, these are year to date numbers through the end of August. You can see the S&P 500 down almost 3%. It's actually gotten a little bit worse in September. I think it's down about 2.97 or so. The Russell 2000, down almost 3%. It's come up a little bit in the month. The EAFE benchmark is actually negative now, and emerging markets and commodities have been really bad, and that's really influenced by China, both of those. China has drug down emerging markets, and commodity energy prices, oil prices coming down, and slower growth from China has really pulled down the commodity sector as well. From a style standpoint, and this really ties into things we're seeing in the portfolio, just looking at the next page, this is U.S. markets. One of the other factors that we've seen, and certainly with respect to currency, the dollar appreciating relative to foreign currencies, and a number of foreign currencies depreciating relative to the dollar. The Chinese have, Bank of China lowered, devalued their currency. That had a pretty major ripple effect on markets. From a sector standpoint, domestically in the U.S. markets, you see healthcare is the one area in both small cap and large cap that is positive. Within large cap, it's slightly positive. Healthcare is pretty insulated from currency impacts. Most healthcare companies generate all their profits domestically, so the change in the value of the dollar isn't impacting them. But within large cap, you have many companies that are multinationals that are generating revenue overseas, and when they, from an accounting standpoint, when they convert that back into dollars, it's been an impact. Energy sector, worst performing sector. I know I've also handed out the agenda for the conference. We're going to have a session at the conference with 3 private equity fund managers that focus on energy. I think that should be an interesting discussion. You know, one of the things, the differences with private equity managers is they're much more opportunistic in when they're putting money to work, and also when they're selling things. So the glass is always, whether it's half empty or half full. If you have money to put to work, now's maybe a good time to do it because things are cheap. If you have money that is currently invested or was invested 2 or 3 years ago, it's a much more difficult time. So that should be a good session on the energy sector. The other, where this ties in from a sector standpoint is from a style. So growth continues to outperform value as we look at growth managers versus value managers. Within both large and small cap, growth has outperformed value by a pretty considerable margin. Just moving forward a couple of pages, similar story for non-U.S. markets, but I'm going to focus on emerging markets. If you go to page 4, you can see this has been a pretty difficult place. From a sector standpoint, every sector is down roughly in double digits within the emerging markets. From a country standpoint, several really stand out, but they're somewhat small. Greece and Turkey down 52% for Greece on a one-year basis. Turkey down almost 28%. They're relatively small components of the EM benchmark. China, which isn't down as much, but it really dominates the emerging market benchmark. China's now 23.25%. It was close to 25% at the end of the second quarter, 25% of the benchmark. So you can see just that devaluation in their markets has taken the percentage that China makes up of the benchmark down quite a bit. Really, and I think I talked about this last month, if we looked at the end of June, China was one of the better, if not the best, performing country in emerging markets year to date through June and on a one-year basis. China has sold off dramatically since the end of June. From a manager standpoint, a portfolio standpoint, exposure to China is the primary driver of relative returns. And you may recall with your managers Von Tobel and Wasatch when they were in, I think they were in April, and that was a bad time for them to be here because April was a really good month in emerging markets and it was a good month for China. And so they were behind their benchmark by about 6%. Now, while they are down because the emerging markets are down dramatically and everything's down, they're well ahead of their benchmarks, and this is what we would expect from both of those managers to preserve capital in more declining markets. Just turning to your portfolio from an asset allocation standpoint, the broad asset allocation, if we look at the middle of the page, the table, not the bar charts, the equity overall is 1% overweight, so really I would consider that in line with targets. But within equity, small cap continues to be the most overweight, so that's Times Square and Earnest. Both of those managers have done very well. We would continue to suggest that that be the source for operating needs. If you have to raise capital, that's continue to be the source. Fixed income, again, just slightly overweight at 1.5%. The most overweight is Core Plus. That's the Western or WAMCO portfolio. That had been by design, and that had been fairly beneficial over the last several years. It hasn't, as spreads have widened and treasuries and mortgage-backed securities have outperformed, WAMCO has much more credit, high-yield exposure, but they've actually held up okay. On a one-year basis, they're up 1.34%. The benchmark's up 1.5%. So that hasn't been a major impact, even with the more opportunistic nature of that. Your global bonds, which is Brandywine, global bonds are targeted at 7.5. They're a bit underweight. That underweight wasn't a tactical underweight. That's due to market depreciation. They're down quite a bit. Down 8% relative, 8.8% on a one-year basis relative to the World Government Bond Index, down 7.7%. That's that currency impact. They're investing in foreign markets, looking for relative value and yield, but the currency, which sometimes helps, currently has been a headwind, if you will. The couple of areas that we will talk about a little bit more next month, private equity and opportunistic real estate continue to be underweight. These are areas that require ongoing commitments to new funds. Next month, we will have a recommendation for a what we would call a re-up to a new fund from an existing manager, Warburg Pincus. Warburg Pincus is a large, globally diversified growth equity fund invested in private companies globally. You're in Warburg Pincus 10, I believe. No, Warburg Pincus 11. That was, you invested in November of 2012. It's about 75% called, meaning 75% of the capital they've taken down and invested. They are raising a new fund now. They're in the market now. Probably have one close, maybe a second close for large investors that can't quite get in, but the next close that we think we'd like you to get in is November 1st. So next month we'll have a formal recommendation on that, and we're going to get legal documents to your counsel beforehand just to make sure that he's reviewed them. But that'll be coming. I just wanted to give a heads up. And we may have some things on the real estate side. Currently on the opportunistic real estate, you have just a couple of pieces, or just one, TA Associates. They're pretty much fully invested. There's a couple of other things that we're looking at. You know, the timing of when opportunities come to market can be sudden, and they can close rapidly. So we bring them when they're available and once we've done all of our work. Just turning to page 10, I think this is a useful page, and you really can start to see from a performance standpoint, your portfolio, while absolute returns are certainly disappointing, it's to be expected. We're not going to have, we've had 5 very good years, really 5.5 very good years. There's going to be periods of time, as we know, where markets go up and down. In these periods where we're going down, what we would expect is that this portfolio is not going to be down as much. You have a lot of defense or insurance built into it. The active managers in this portfolio, while we've when the market's going up, oftentimes it's difficult for active managers, more fundamentally oriented managers, to outperform when everything's going up, but they really earn their stripes, or should earn their stripes, when in more difficult market environments, and we're seeing that now. So on a one-year basis, the one-year return through the end of August, portfolio slightly down on a gross basis, down 33 basis points, down 93 basis points net of fees. The policy index is down almost 2%, 1.82%. So your actual investments are saving some money, are outperforming. On the 3-year basis, up 9% gross and 8.5% net. But if we start to look at the individual components, so this is looking at the asset classes within your asset allocation. Large cap. Large cap is outperforming the S&P by almost a little over 1.5%, and that's the most efficient part of the market. We wouldn't expect to get as much excess return within large cap because it's a very efficient market. You're implementing there with an index fund, the SSJ index fund, and Intech, which is a very benchmark risk-controlled strategy, although it will take some slight deviations from the benchmark. But that strategy has really outperformed. The last year has been very good for Intech. They're up 3.75%, and the benchmark's up 0.48 for the S&P 500. Small cap, your small cap managers have held in there, down 6 basis points. Benchmark's down 32. Really earnest on the value side has added the most from a relative standpoint. While they're still negative, they're 300 basis points ahead of the Russell 1 or Russell 2 value. So doing very well. And then I think this is really indicative of why you have the insurance portfolio you have in your total fund working, the long-short composite, which is K2. I've stood up here for the last 5 years saying long-short's been a headwind as markets are up 10 or 15%, and your long-short's up 6 or 7. Well, now you can see what it's doing. This portfolio is up 6%. In a flat market environment. Really, we're comparing there to the HFRI fund-to-fund strategic, which is a peer group basically of other long-short equity fund-to-funds. But the better proxy from a risk standpoint is the S&P 500 or the ACWI, which is flat also for that period. So not only are they protecting, but they're adding alpha in this type of market environment. Private equity portfolio, this is not necessarily a fund. It's different than the long short in terms of the protecting in this market environment. This is more a function of lagged market values in accounting because you're not seeing the markdowns of private investments as rapidly because they don't mark the holdings to market. And last year was actually a very good year in the private markets in terms of realizations and M&A activity. So up 14%, so it's being pretty additive. Your international portfolio, international developed, which is Harding Loevner and Lazard, basically in line with the EFI, not too much dispersion there. Unfortunately, the EFI markets are down. Emerging markets, which I said, disappointing on an absolute basis, but really adding almost 8% over that one-year period in terms of protection. Von Tobel, we know, is a very defensive manager, significant. They're going to have significant holdings at all times in consumer staples. They're really focused on a growing middle class in emerging markets, so consumer selling into that consumer demand domestically in emerging markets, as opposed to the index. If you think about the index, there's a lot of commodities in that index, a lot of commodity producers in those emerging market countries that are reliant on global demand from whether it be China or developed Europe or the U.S. to buy those commodities. The strategy you're in is more focused on people in Mexico, India, peripheral countries to China having more money and spending on products. That tends to be a bit more defensive, but it's held up fairly well. The real estate, This number is really just half the story, because the private real estate, the Morgan Stanley strategy doesn't only updates on a quarterly basis, so you're really just seeing the commodity component. Real estate has actually done well. The Morgan Stanley Core Real Estate Fund has had a good year, as has all commercial real estate fund. This is really through June, up 16%. Those numbers on page 12 are for Morgan Stanley. Those are through June, because they don't update on an inter-month basis. But still, we would expect to be up 13-14% still. So while it's been a really difficult couple of months, August and September tend to be not great months generally due to lower liquidity in the markets. There's been a confluence of events certainly that have led to what is probably a fairly healthy correction. Valuations are a little bit more attractive again. That's not to say that we know that things are going to turn around immediately, but we do believe that this isn't a 2007, 2008 type time period where the economy, and there was so much leverage in the economy that was really going to be difficult. The U.S. economy is actually performing fairly well, the real economy. Markets have corrected, and markets have run up ahead of the economy, but we think there's still some room to run for equities to turn around going forward. The other thing I handed out was just the conference agenda. Just as an FYI, things have come together nicely. I think I've mentioned this before. We're doing, from the comments last year, I think we had one panel discussion last year. We got a lot of positive comments on that, and people wanted to see a little bit more of that. So as opposed to having one speaker after the other just standing up there talking, we're going to have, I think, 4 panel discussions with groups, and Trustee Randy Thurman and Wiley are going to participate in one, and W.B. Smith will moderate on a participant issue panel, and then a couple of other panels, one on hedge funds, one on energy, that's one on fixed income. And then we'll have Anastasia Amorosa from J.P. Morgan, who I know did a really nice job last year. Saw her on CNBC last week. She'll be kicking off the conference with just a global economic update. Vicki Johnson and Cindy Burley from Davis Graham & Stubbs will be there on Wednesday. We call it new trustee education, the Wednesday sessions. It really is just blocking and tackling that I think is good for everybody if you can make it. We do the investment session first, where we'll cover asset allocation in detail, investment policy, manager evaluation, benchmarking, and all of those things. So it's a good refresher for everyone, not just new trustees. And then the legal session will be more on fiduciary responsibilities. Louise Gates will do a session on the mortality tables. And I like her title. We're living longer, and that's not a good thing for pension funds, as you know. And then Hank Kim will be there on Friday to give an update on the national pension scene. And then we'll end with, for some of you, it's a positive, I know, with Joe Castiglione, and others may want to throw tomatoes at him. I don't know, somebody with an orange tie, I don't know. So hopefully you can all make it, and we're looking forward to it. I know that attendance numbers look like they're going to be good again. So I think we're well over 100, 110 or so.
Renee, is it too late to sign up? Yes. And where is that located? Norman. Yeah, I know it's Norman, but which location?
At the Postal Training Center.
Something on Highway 9.
Jason, just a quick question. Based on the alpha or downside protection that we're receiving from our managers, do you think the fees are reasonable at what we need?
Yes, we do. And we do I'm not sure when the last time we provided it to you, a fee analysis, but we do a benchmarking of all your managers, looking at the fees and where they are relative to the size of the mandate that you're in and what you're getting, and then at the total plan level. So we can update that for you. But in addition to that, every summer, this is a project that we have our interns work on, and it actually works out well, and we've found that we've gotten some fee savings from this. We have our interns call or an email every manager in every client portfolio, and we get the managers to confirm that the fee that that particular client is paying is the best available fee for that size mandate. Now, oftentimes, you may have most favored nations clauses in some of your separately managed account contracts, which requires the manager to come to you and say, we need to lower the fee. Sometimes, if nobody asks, they don't change it. So we get a confirmation that you're getting the best available fee. I don't think there wasn't this year any in your portfolio, but I can think of two off the top of my head where we got about a 10 basis point reduction for clients in portfolios. But we'll provide an update on the fee study, but my point is we're looking at that regularly.
Any other questions for Jason? Okay, thank you. Item number 10, comments from board, staff, and citizens. Hearing none, we're adjourned at 10:26. Thank you.